This is the most important thing that you could ever listen to if you're thinking about buying a house. Are you ready? So check this out. Everybody's always like, what does it take to qualify for a home? I don't know. I mean, what do I really know? I mean, 20 years in the mortgage business, full time, helping over 3,000 people buy a house or refinance a house. I mean, but check this out. This is all you need to know. There's 3 categories that the underwriter is going to look at when they're underwriting your loan. Underwriter? What does that mean? An underwriter is basically a fancy word for a gatekeeper of the bank. You know, the gatekeeper is going to release the money to you that you're borrowing to be able to buy a home. So they're looking at 3 categories to see if you qualify. Category number 1. Are you ready? LTV. Loan. 2. Value. Simple math. You take the loan amount, you divide it by the value of the home. The lower the percentage, the better off you are. So let me give you an example. If you bought an $800,000 loan on a $1 million house, $800,000 divided by $1 million, you have an 80% loan to value. 80% or less is the best. You got 20% down. The loan to value is basically the amount that you're borrowing from the bank. Okay? They want to know in a percentage format. All right? They don't care that you have 10% down. They care that they're lending 90% out. Think of it like a bank. That's how you have to think about it. Second category, more heavily scrutinized than you would believe. This is the main culprit. This is the main category where people either make it or they rinse out. They don't make it. This category is called DTI, debt to income ratio. Very simple math again, but a little bit more complex math. You ready for me? We take your monthly debts that are listed on your social security number, like linked to your social security number. Let me give you an example. Credit cards, auto loans, student loans, personal loans, mortgages, things of that nature. And then we divide it by your gross monthly income. Gross? No. Gross monthly income before taxes. Okay? Still don't get it? No worries. I'll give you a live example. So let's say you have $200 a month on a $10,000 credit card. Then you have a $500 car payment. So that's $700. Then you have a $300 student loan payment. No longer in deferred because you're old like me. So that's, what is that, right? 300, 200, 500, that's $1,000. Then your new potential mortgage payment is, let's say, $3,000. So that's $4,000 a month that you have in debts or potential debts. Now let's look at your gross income. Your gross income is $10,000 a month. You make $120,000 a year. Good for you. So 4,000 divided by 10,000 equals 40% DTI. So 40% debt to income ratio. I want to see you at 45% or less. I want to see you at 45% or less. Now you're probably like, well, that's what you want to see us at. Where does the bank want to see us at? The bank's down to give you a loan. At many programs allow you to go to 50, 57% debt to income ratio. But let me ask you a question. If you make $10,000 a month, after taxes, let's say 30% taxes, let's just use a rough number, you're at $7,000 take home. With health benefits and all that, you're at $6,500 take home. And if I said, yeah, we'll give you a loan for 57% of $10,000, that's $5,700. Well, how much money is left over for groceries, for your cable bill, your cell phone bill, for all your regular day-to-day living, going out and eating? Not very much. So that's why I like to say 45%, but I'm from the old school. You know, I joke like that, but I'm really from the old school. I'm from the old school where times are tough. Mom would make you drink expired milk. Ugh. Your parents, did the best they could, but you sometimes didn't have heat. So if my situations that I grew up with, don't resonate with your situations, no problem. Change the channel, move on. Go find somebody that's going to give you a loan for 57% debt to income ratio. And in many cases, it might work out. Maybe you're on the horizon for a raise. But if you're conservative like me and you don't want to really fail, you want to have the least amount of chances to fail, stick to what I'm telling you. All right, we talked about loan to value, debt to income ratio. One category left. It's credit grade. Credit grade. When you borrow money from us, we're not going to loan you money in a cash in a suitcase. We're going to give you paper. That paper is going to be traded on Wall Street, and the paper is graded. The investor who buys that paper is going to say, is this good paper? Is this good paper? Is this borrower good? Well, they graded an A, B, C, and D paper. A paper, the best paper out there, is 740 and above credit score, or excellent credit. B paper, or good credit, is 680 to 739 credit score. C paper, or fair credit, is 620 to 679 credit score. And D paper, which is poor credit, something really serious has gone on in your credit score, you're not ready to buy a house, is 619 or less FICO score. So if you're watching this, you're like, dude, I got a 550, 580 credit score. Yeah, you made some bad choices. It's okay. Don't get all mad because I said that on camera. Do something about it. Do something about it. Do something about it quick. Because wherever you go, your credit's going to haunt you. Like, for reals, it's going to haunt you. If you don't believe me, don't do nothing about it. See how far you get. This country is built on credit. You know what my country is built on? If you stole in my country, remember the movie Aladdin? Like they're literally trying to chop hands off? Believe it or not, there's countries out there right now that if you stole an apple or you stole something, they would chop your hand off. You'd be like this. You'd be like, oh my God, right? But this country, the greatest country on the planet, gives chances after chances. But you got to take the initiative to make sure you don't blow your chance. So if you have bad credit, you need to face the music. You need to pull I got a whole video that I'm created that, helping you improve your FICO score for free. If you need help with it, just comment below and I'll try my best to help you the best I can. But these are the 3 categories that an underwriter is going to look at when you're going to apply for a home loan. And I hope it helps you. Put yourself in the best category you can so you get a great interest rate. Thank you, and we hope that you choose KEES Lending.